Good morning, welcome to Goodwill. In this video presentation, we will see how we can trade in Mcx crude oil options market. As we had mentioned earlier, we are starting the new option series for Mcx crude oil, and in this analysis, we will present our views and what are the possible strategies you can apply in Mcx crude oil options. When we see options in commodities, only we could see some sort of liquidity, not a great liquidity, very few, a little bit of liquidity in Mcx crude oil. And since the SEBI has regulated the margins exposures, most of the crude oil traders are struggling to take some exposure into this market. So we could see few of the crude traders, traditional seasoned crude traders, they are staying away from the market. But in Goodwill, we are taking some initiative to trade in the crude oil options market, where the margins may be a little bit low compared to trading in the futures market. So let's proceed with our today's analysis. So the chart you're seeing is the 60-minute candlestick chart for Mcx crude oil. So every single candlestick represents 60 minutes. First, now let us understand the overall market outlook for this particular contract. If you see the chart, you could identify 4,900 as a decent support. So around July, the price took support near 4,900, went up and came down, again took support, and again it tried various occasions when the market was recovering. Recently also 4,900 provided some support. So we could easily identify 4,900 as a support in this market, in this particular contract. And the next major area is 5,200. So whenever the price is climbing up, it has stopped near 5,200. On this area also, it had converted that into a resistance. When the price was taking support around 4,900, it found resistance around 5,200. So whenever we say support or resistance, we cannot say that 5,200 exactly the price will come and hit it. It is a zone. So few buffer you need to have above and below this resistance line. So 5,200, on reading this chart, we could see that 5,200 and 4,900 is playing some key role in this particular contract. Now the price is trading around 5,060. So slowly from 4,960, the price is moving towards the key another resistance of 5,200. So the first view is we need to hit on this resistance and see whether this 5,200 actually can provide a good resistance, whether it is going to resist, because we have only 3 weeks for this contract to expire. So the first option is sell till 5,200. Let us see how the market is going to react. This is going to be the first option. So our view is the market may not move above 5,200. So it can found a resistance and it can stay below. This can be one view. Okay. So let us keep this aside. Now let us see the other view. The other view is, even if the price is moving above 5,200, till what range it can move? So the price started from 4,650. So what are the chances that the price straight away breaks 5,200, go all the way towards move above 5,500? So that is also not possible. So the next view is, if at all, even if the price is moving above 5,200, the market will be within the range of 5,500. Okay, the market will be within the range of 5,500 and 4,900. So this is going to be the range where the market can play. So we have two views. Okay, one is staying below 5,200. If it is moving above, we have another view that the price will hold within a certain range. So now let's go and see the option chain. So I hope you have some clear idea about the overall market outlook. See, so many times when you had posted some educational videos, we had mentioned this very clearly, that for the market outlook we need to frame the strategies. So now, since this is the option chain, you can see the option chain in the MCX website also. So we could easily identify this 5,050 or 5,100, maybe that the money option. And if you see this chain, this particular column, volume column, only the strike price is divided with 50s. So you can see 5,150s with the difference of 50s, we could see a built-in strike price. But even then, only the whole numbers have some volume, and mostly you need to deal with the at the money option in crude oil, because that's a strike which is having some decent volume and the next out of money option may have some decent volume. We cannot go further away from the out of money deep or out of money options because of the liquidity issues. Only if we start trading, then we could also create that liquidity. When more people participate, the liquidity factors will be taken care of. So the first objective is very simple. 5100, wait for the price. See, maybe what you should do, you can wait for the price to come near 5100 or 5150 or within or near 5200. So that is up to the individual to wait. So what we can suggest is, assume that, so you can sell this 5100 call option. When you sell call option, it means that your expectation is that the market is going to come down, okay? Or else you can say, in other words, the price may not go above 5100. So it is your choice based upon the liquidity. We have some liquidity issues here in that. So wait for the price to move towards 5200, or you can take that call, or you can select 5200 strike itself if at all you get a decent liquidity. So you see the price is around 100, okay? So in both the cases, since you sell, you receive the credit, okay, you receive the premium. For this example, let us take this 5100 itself, 142.5 maybe the premium. So this ends up again in paying huge margins. As a seller, you need to pay the margin like futures. So in order to cut short the margin, or in order to make this as a strategy, what you need to do is you need to buy this 5200 call option also. So what will happen if you see, I'm having the calculators here. See, 5400 strike, you see you receive 142, and the next 5200, what you pay 100, since it is a buyer, since it's a debit trade. So the next 42 as a seller is going to be your credit. Okay, this 42 can be your profit if at all the price stays below 5100. If you are going to select this pair 5200 and 5300, for example, you can select 5000, see 5200 is 100 minus 5300 ends up with a premium of so you make it 33 rupees. So not much difference. So it depends upon your view. So this is called credit spread, okay? So it means that the maximum profit what you can get is limited to the credit what you are going to receive, that is 33 rupees if you, in case you select 5200 strike, or 42 rupees in case you select 5100 strike. So it depends upon where the market may open on Monday. So the advantage of this is the loss. See, now we know about the what's going to be the profit what you are going to get. The loss is we are selecting a 100 point different width of the strike. The difference, the width of the difference between the two strikes, selected strike is 100. Okay, so minus whatever we are going to get as credit, it comes around 58 rupees. So this is going to be the maximum loss, and that's going to be the maximum profit. So the view is very clear. What you need to do is we expect that the 5200 can provide resistance. So if at all the price trade below 5200, you're going to make that profit. We don't want to go with a negged sell, because it takes maximum amount of margin requirements. So what you do, you sell this and you buy 5100, or you can sell 5100 and you can buy 5000. So you are limiting your loss and you are limiting your profit also. So this is a credit spread where you can apply in crude oil market at this stage. And there is one more thing also you can apply. Like I said, we have two views. If at all if the price starts moving above 5200, it's very good that you can sell 5200 call and you can sell 5200 put. So this is a short straddle. So don't confuse with the names, and if you don't get these technical terms very clearly, please go to our YouTube channel and see all the educational content. And I may put the playlist at the description box, so you can check that also. So what happens is, let's go and see the option chain. So 5000, assume that because for a straddle, short straddle to work, we need to select the at the money option. Assume that the price is approaching or moving near 5200. If the price is coming near 5200, you can apply this. So if you see the at the money option premiums, so 142 on the put side, and sorry, call side, and 178 on the put side. So the net premium what you can possibly get is around 320. For easy calculation, assume that it is 300 rupees. So now come to the chart. So what it says is, when you sell call and put at 5200 strike, you receive 300 rupee premium. So 300, 400, 500 till 5500 on the top, and till 4900 at the bottom. Okay, so if the price is going to stay within this range, you can make profit. So that is, I think, this also looks very good, but even though because the logic is quite clear, unless until there is something that can blast the market, crude oil market up, it is highly illogical that the price from 4600 breaking 5500, creating new highs. I think with the resistance of 5200 at in between, there are a lot of chances that the price can close within this range also. So both the strategies are highly effective at this market condition, we think so. And if you are interested, you can apply this strategy. And if you have any doubt, we know that if you are a crude oil trader or if you are a commodity trader, you would not have great exposure towards the options market. Please read all our tutorials. Please post all your comments. So let us see what's going to happen. Kindly open trading account with Goodwill. For account opening, give me call to 937 927 and subscribe to our YouTube channel. Take care. Bye.